The United States economy is now dependent on a historic surge in artificial intelligence investment to stay afloat, according to recent market analysis. New data reveals that without the massive capital infusion to AI infrastructure, the U.S. would currently be in an economic recession. The analysis by the Kobesi letter, utilizing data from Bank of America's global research, highlights that AI-related spending was the dominant force between the nation's economic performance in the first 6 months of 2025. AI spending contributed 62.5%, or a full percentage point, to the 1.6% U.S. GDP growth during that period. Quote, without AI, the U.S. would be in a recession, end quote. But there is AI. There is. This economic reliance is driven by what analysts are calling historic levels of tech spending. According to data from top-down charts and LSEG, technology and related stocks now comprise a record-breaking 45% of S&P 500 capital expenditure. The figure has risen nearly 20 percentage points in the last decade, surpassing the peak of approximately 39% seen during the 2000 dot-com bubble. The chart illustrates a stark divergence between the new economy and traditional sectors. We talk about that on a regular basis. While real private non-residential fixed investment data centers has soared nearly 300% over the past 3 years, inflation-adjusted investment in traditional structures such as offices, hotels, warehouse, and factories has remained almost flat. For anyone that wants to go through this, the Kobesi letter does really great research. They produce great infographics as well. They're definitely a good follow, by the way. Not affiliated with Benzinga, but still a good follow. If you want to go through the story and any of the related or linked tweets, they're in there in the chat for you. Meanwhile, as tech spending goes through the roof, the capital expenditure rate for commodity sectors in the S&P 500 has halved since 2015 to just 15%. According to Kobesi's post, hovering near its lowest recorded levels in the past 45 years. Peter Anderson, CIO of Anderson Capital Management, has warned of massive overbuilding amid questionable demand, noting that major tools like ChatGPT are not locking up from overuse. However, Futurum equity strategist Shea Ballure argues the cycle differs from the dot-com bubble, contrasting the idle fiber optics of 1999 with today's 80% GPU utilization. So he goes on to say here that this is why the AI cycle is nothing like the dot-com era. These are comparisons that we hear all of the time. This person's refuting that, and he's citing that the early 2000s fiber ran at about 7% utilization because the industry actually just built far ahead of the demand that actually never showed up. The physical layers scaled faster than the software, but this time around, we're actually seeing the inverse, NVIDIA clusters inside Microsoft. So I don't know how this is all going to shake out here. A lot of the, really experienced, smart people that I've talked to, while they acknowledge that there are definitely some similarities, it really doesn't feel the same at the end of the day. Now, again, I'm not sure how this is all going to shake out, but there you go.